If you are in your mid-60s, retired or approaching retirement, and you're thinking about a Roth conversion, you might want to think twice. There's a sneaky provision to the Medicare laws that could end up making the conversion much more expensive than you're planning. For roughly the past 20 years, Roth contributions and conversions have been all the buzz. This ramped up considerably in the late 2000s when tax laws changed and removed the income restrictions that had once existed on Roth conversions. This gave virtually anyone who wanted it access to Roth IRAs simply by converting their traditional IRAs into Roth IRAs. If we go back about 40 years, the advice was completely backwards. Popular sentiment back then was take as many deductions from income as you can get because chances were extremely high that your income would be lower and therefore your income tax bracket applicable would be lower once you retired. During the 90s and the 2000s, these tax brackets compressed pretty significantly and thinking changed on that. And while it's been my experience that a number of people still today retire in a lower tax bracket than they were in while they were working, non-taxable retirement accounts are definitely in the popular crowd. And in many cases, there's a perfectly good reason for this. Roth money simplifies your tax planning. You can withdraw funds with zero income tax liability, and you can pass funds to your heirs with zero income tax liability to them. And because of the tax-free withdrawal treatment of Roth IRA money, you can make substantial withdrawals against the accounts for major purchases without a major tax headache. This, in some cases, is just as dangerous as it is helpful. Now, we hold the opinion that Roth conversions are often overstated and oversold in terms of their net benefit. There is still no denying the appeal, however, of tax-free accounts with tax-free income. But if you are currently enrolled in Medicare or are close to enrolling in Medicare, there's an extremely important component to Medicare law that you must understand because it could become a prohibitive factor when it comes to affecting a Roth conversion. The specific component of Medicare law at issue here is what we refer to as IRMA, which is an acronym standing for Income-Related Monthly Adjustment Amount. And the TLDR explanation is IRMA can make your Medicare premiums more expensive, much more expensive in some cases. Normally, when you enroll in Medicare, you're going to enroll in parts A, B, and D. And for most people, the premiums that you will pay for these components of Medicare are $0 per month for Part A, roughly $170 per month for Part B, and $0 for Part D. I am completely ignoring the Medicare Advantage plans or Medicare Supplemental Medigap plans, which are also an option which would come with additional expense in most cases. But the typical programs that you would enroll in through the Social Security Administration office are Medicare's Part A, B, and D, and their costs, again, $0 for Part A, $175 roughly for Part B, and $0 for Part D per month in all cases. But if your income crosses certain thresholds, you will be subject to IRMA. And if you become subject to IRMA, it could affect Parts B and D. The maximum monthly premiums under IRMA for Part B of Medicare is $594 a month and $81 a month for Part D. That's a pretty substantial increase in premiums. In addition, IRMA has a 2-year look-back provision. So the impact that it could have on your Medicare premiums can last more than just 1 year. And if you're thinking, I'm not planning to enroll in Medicare just yet, I've got a few years, you need to be aware of the look back because decisions that you make in advance of enrolling in Medicare might result in you still being subject to IRMA. Now, how does this all tie into Roth conversion? When you convert money to a Roth IRA, you are going to recognize the conversion amount as ordinary income. That additional ordinary income is included in any other income that you have, and all of that income is looked at to determine if IRMA applies for your Medicare premiums. So if you have accumulated a substantial amount of money in an account like a 401k, a 403b, a 457, a traditional IRA, a Keogh plan, a SEP IRA, a simple IRA, an ESOP, and you intend to roll it into a Roth IRA for the tax benefits of Roth IRAs, the entire converted amount will be included in your income. This could put you past the IRMA threshold and substantially increase the premiums you will then pay in the following year for Medicare. This would also apply to any pension lump sum that you roll into an IRA and then convert to a Roth IRA. And it would also apply to any of the investment gains you've achieved on a non-deducted IRA account. This would include things like a non-deductible IRA, which for some strange reason you never converted trying to execute something like a backdoor Roth, as well as any contributions that were made to a 401k in excess of the IRS allowable deductible amounts. Keep in mind, this means that you will not only pay a fairly large tax bill for the conversion, but you could also then be paying a substantially higher premium for Medicare Part B and D. And factoring this in might change the assessment on whether or not a Roth conversion makes sense. Now, there is a little bit of good news in all of this. Once the look-back provision has elapsed and your income theoretically goes back to normal and is no longer beyond the IRMA thresholds, your Medicare premiums will also return to normal. But if you are currently enrolled in Medicare, or you are close to enrolling in Medicare, you need to be very aware of this provision of Medicare law and be extremely careful about creating additional recognizable income, including income that would be created through a Roth conversion. And please, please, please note that financial advisors are generally not tax advisors, and most of them will specifically disclaim any liability to you for negative tax consequences you incur by following their advice. So taking the advice of an advisor to make a Roth conversion does not mean that they have necessarily assessed the risks you face when it comes to tax law. And if you end up paying much more in taxes than you assumed, there is no liability the advisor would normally hold to you. Now, of course, if you are not currently enrolled in Medicare and you are well outside of the 2-year range to claiming Medicare benefits, then you do not need to worry about IRMA in the case of a Roth conversion. There are several other factors you might want to contemplate when it comes to Roth IRA conversions, but in that case, IRMA is simply not one of them.